Well, in the last few days, we have seen markets trying to build a base, certainly in risk assets, but certainly in things like SOFR spreads and what we've been seeing in the long end of the treasury curve. They say that breaking markets eventually break, and that's where we've been seeing things really move alive. Donald Trump had to act, and he has acted fairly emphatically, and he's caused one of the biggest moves we've ever seen in equity markets. We've seen implied levels of volatility absolutely cratering. Certainly the VIX has had its biggest one-day decline we've ever seen. We've seen big moves in FX markets, commodity markets have come alive. But the question is are we out of the woods? Was this a necessary situation that had to be enacted before we saw some sort of systemic, maybe SVB type situation come to the floor? The markets are questioning where we go from here. Risk assets have rejoiced, but can it sustain? That's all we're going to discuss in the trade-off today. Well, these are crazy, chaotic markets. They have been for a week or so, and they may well remain so for a period of time, although we have seen relief coming through in equity markets. And as I say in the synopsis there, the question is will we see risk build going forward? And I'm still fairly sceptical about that. I'm Chris Weston, Head of Research here at Pepperstone. I'm going to bring in Blake Morrow from Forex Analytics in the programme. Blake, how are you going, my good friend?
Whew, man, it's busy.
It is busy. And, We've discussed on the show before that you just literally cannot carry risk over. I know a lot of clients have done, and they've done very nicely out of this situation. You know, in going into today's trading session, everyone was long of Australian dollars. I mean, I think we saw 85% of our open interest from clients were long Aussie dollars. That's worked out really nicely. Everyone was still long equity risk. They'd seen the risk reward markets obviously building a base. So clients have done pretty nicely out of this situation, which is fantastic to see. But the question now is are we in an environment now, and we discuss it obviously more in Topical Thunder, where we can have a bit more conviction that maybe we can go on a sustained bull run, or are we in a situation now where we're just the visibility is still very low?
Yeah. Well, a couple things there. If you had summer plans, you can just scratch off July 9th. Just get rid of those plans. And then also, I think we got 3 months where the dust is going to settle a little bit. Am I still going to be trading intraday? Is it implied volatility still very high? As you pointed out, it is. And I don't think that's really going to subside. But I think, as the dust settles, we will have a couple of days here and there where we can probably try to carry some risk, short risk, long risk, both directions over the course of the next couple months. It's going to make for a very lively three months time.
Hopefully, but I think rate cuts are coming off the table now, and I think there's probably quite a few people on the Republican camp in the halls of Washington at the moment in White House who have probably made some nice money out of what we've been seeing. I won't go into too much about that, but there's trial balloons being thrown around, and I think people may not have known about this situation well in advance. Maybe they traded it, we don't know, but that's obviously a whole nother subject. But obviously, I think the markets are telling you right now that they believe those countries who have seen their tariff rate down to 10% will probably that's probably where they'll remain for a period of time. Obviously, China's the elephant in the room, and in that situation, maybe they can move on. Maybe we can start talking about earnings. Maybe we can start talking about tax cuts in the future. But let's discuss all those factors in Topical Thunder. Did the markets win? Well, I came in this morning. And first thing, I was speaking to a journalist. He said, did the markets win, Blake? That said to me, and I'm asking you the question now because, the way I responded to this is he's obviously Donald Trump's going to frame this that he's got a great deal, that he's gone aggressive and he's got a great deal on the table for the American people, and he'll obviously claim this. But at the same time, I wouldn't necessarily say the market's won. I think if you look at the moves in SOFR spreads, the long end of the curve. As I say, you're just not going to get that kind of movement without something bad happening. And, for me, realised volatility in financial markets is the most important factor in trading. In financial markets, the epicenter. There is nothing more important than realised volatility. And when S&P, 10-day realised vol is trading at, 69%, the move index, I know it's more implied on treasuries, is 140%. You can't have levels of those kind of realised moves for a period of time without something bad happening to markets. And Jamie Dimon pretty much said that yesterday you've got to act now. I mean, Goldman Sachs calling a recession. I know that was, we don't want to talk about it too much, but, I think people were talking about recession. People couldn't price risk. Things were breaking. And I think that was the moment that he had to buckle. Otherwise, bad shit would have happened. And I think, so did the market win? Probably. The 10-year bond auction was amazing as well. So that really helped sentiment. But I think it was more a case if he didn't act at that time, I think we're probably running into the risk of some sort of market shock coming through.
Last night, Chris, before I went to bed, it was early in your session, just a couple hours from now, 24 hours ago, stocks were down, futures were coming under pressure, bonds were under pressure, dollar was coming under pressure. For decades, I've told traders in our community, I'm like, if that ever happens, being an American and thinking about this, if that ever happens, that's a complete loss of confidence in the United States. When those three things happen, I wasn't sure if I'd ever see that in my time. It was happening last night, and I was really worried that I was going to wake up this morning during European hours and we would see equity markets down 10 or 15% and the futures limit down, multiple limit downs, different markets. Fortunately, that didn't happen, but I have to assume that when you ask the question, did the markets win? I think there was enough people freaked out because even Donald Trump said it in his press conference today. I got a lot of calls. People were worried. Yeah, everybody was worried. Everybody's long the equity markets. They're long. They own stocks, and they've just seen 20% evaporate over the course of the last week and a half. So yes, of course, or you'd say 2 months, but majority of it in just the last week. So of course, everybody's freaked out. And yes, the markets did win. People say that it's Trump, the U.S. and Trump's playing chicken with China, right? Yeah. I think Trump's playing chicken with the market right now, and he blinked, he flinched, and rightfully so, because as you pointed out, volatility that high for that long, it is going to break something. And when we break something, it's.
But you've got. I mean, I think there is probably a lot of people on the Republican camp saying, I know we've got midterms coming up in November, and the way this is going, this is not favouring us at all. I mean, I think first of all, I know we've got on to the next question, but the power that one man wields. I know everyone talks about the Fed and the influence they have on pricing and various facts, but this one man controlled everything in financial markets really for the last couple of weeks, and he probably loved that. He loved the fact that he could come out and Scott Bessent could come out and say, oh yeah, we're happy the things are going, and markets were full, but he knew that he could cause the market to react 8-9% to the upside. The power this one man had over the whole financial system is absolutely insane. So I think the midterms is something there as well. But I had a mate call up yesterday, and he goes, Chris, I want to hedge. Volatility is too high, so I can't be buying put options at the moment. Gold's not really, it wasn't as flatline, positions saturated. Treasuries were selling off at the long end, big curve steepeners, and no one really. We saw the yen and the Swiss franc doing okay, but it wasn't really doing great. Goes, what's my hedge now? I said, mate, if you're hedging now, you deserve to lose money because you've missed on the boat. So you've missed that boat now, and glad he didn't, because the markets obviously rallied pretty hard. But I mean, it was all a bit crazy. I think that's where it was. So he had so much power, and I think he had to act, and he'll spin it however he wants to make it look like he's got a great deal for the public. But I think we all know that he had to do something now, and he brought it too far. And I think we'll see that in the earnings season coming up. We've got banks reporting tomorrow, and I think what we're going to see from earnings now is just continued lack of guidance, like we saw from Delta. Just no one's prepared to get it out there and tell us how they're seeing things.
Well, Chris, I want to go ahead and move us on to the next subject. And I want to talk about markets and where our focus should be right now. But you bring up such a great point. This kind of goes hand in hand with this topic. We didn't plan it this way, by the way. We, Chris and I we don't run through this. This is all live TV for you guys. When we talk about markets, you got to ask where the focus is going to be. And I think, like I said, you bring up a great point that one man has this type of control that is going to freak the markets out. That what I mean by that is dollar will be sold on rallies. So if you think that this is a dollar bullish event, it's not. I think you're going to see reserves get dollar, whatever you had in dollars is going to be moving across the spectrum into different currencies. I think that the U.S. exceptionalism story is by far so dead. So when you see rallies like this, you're going to see actually outperformance in other markets and underperformance in Mag 7 and everything else. And you got a man that is a wild card, and you have people that they learned the first time around, they are hedging this next time around. They will be hedging their risk. So, my question to you, Chris, we're going to have a few months, I believe, and it could be sooner, could be more, could be less. I hope it's less. I hope some deals get done, whatever deals that need to get done, so we can kind of move on with our lives. But I would assume we have anywhere from 2 weeks to 3 months, 4 months left of really high volatility. But that means that's going to be diversification into different markets. What markets are you going to be focused on? I'm always going to be keeping an eye on what's happening in the 30-year and the 10-year and yields. But where is your focus going to be?
Yeah, I think the long end of the curve is interesting there. I think, short end and treasuries, I still think there's too many rate cuts now being priced in. If the market's feeling pretty comfortable about the idea that we've got tariffs here and Europe's going to receive any kind of idea about retaliation, and China probably we priced in a worst case scenario there in terms of retaliation, and maybe there's a deal to be struck at further down the line. We'll see. Maybe we can focus on tax cuts. I know the debt ceiling's probably going to become more of an issue as we go into sort of June. I think rate cuts come out of the market in the short term. I think there's more to come on that. I think in equities, I think there's probably some further upside in tech stocks and banks. I'd be still very, very cognizant of being long any kind of cyclical stocks. I think the economy is still very much up for debate here. I think, we've got these tariffs here, but a 10% tariff on these emerging market nations, and with China still there, I still think the cyclical areas of the market are going to really struggle. So there's a trade in there to be long, stocks and relative to the more cyclical areas. I think that's a trade I'm looking at very closely. But where things are breaking down it was in the bond market and the long end, and I think that's where we've still got to watch what's been happening there. And I think that's going to be the focus for me. But I think cyclical areas of the market are still going to struggle. I think it's not like, to me, Blake, we've got this decision and CEOs and executives are going to get into the boardroom and go, hey, everything's solved now. Let's those investment decisions, those CapEx decisions that we put on ice, we've now got the visibility to do that. That uncertainty is still there. And
4 days later, come on, man, why not?
Yeah, it's not like they're gonna propel this up and suddenly we're going to see CEO confidence ramp up and CapEx plans being really sort of pushed out explicitly. That uncertainty is still going to be there. I mean, still people are looking at the inflation that's going to come from this, and still we're trying to price that. And even on these tariff rates of 10%. I think that the effective tariff rate with China on 125% is still north of 20%. So there is an inflation aspect that still needs to play into this. I think the uncertainty still prevails, and that's why we're going to see implied volatility remaining at these levels. I think 30% or so in the VIX translates into 2.1% daily swings in the S&P. And I still think that's a punchy level of movement in the short term. So, for us traders, when we're looking at while expected volatility has come back, these are still levels which are still pretty extreme relative to where we've been. And they still tell us that we still got to be prevalent that at any stage during the day, we can get a headline that can move the market. So, have we got to a world where you can be more confident in those swing trading positions that you typically hold for sort of 2 to 4 days? No. A headline can still move the market significantly, that if you're not awake and able to react and you don't have your stops in the right place, then you could get absolutely whacked still. That's what I say. Mate, let's talk China because we've seen them come out. There has been this tit for tat trade war that's going on, and Trump's put his tariffs up to 125, which is insane. We're waiting for a response back from China today, and one suspects that they probably won't want to perpetuate this situation. They've seen him come out and forge deals with the non-retaliation nations. And so, he's given an idea that this can get where it needs to be. China yesterday refrained from, moving on dollar CNH, the yuan. Everyone expected that dollar CNH to push up. And now we've got this, they're not going to be able to sell goods into the US. The Europeans aren't going to take them, so they need to devalue their currency, or at least gradually allow it. They didn't happen, and reports were that they lent on local banks to to refrain from buying dollars, and that managed to keep dollar CNH in check. And so I was expecting, and everyone was expecting, at the start of some sort of bull trend in dollar CNH, and that hasn't happened either, which is part of the reason why we're seeing Aussie dollar rally so sharply here. So I think China have refrained from. There's three measures that China can go down. One is absolute retaliation on tariffs. One is the currency effect, and secondly is their monetary easing. We still expect, reserve ratio requirement cuts, cuts to interest rates, MLF, and bits and pieces. But I don't think they're going to go down further retaliation on tariffs, and it doesn't look like they're going to go down the currency depreciation situation. And I think they're leaning on state-owned banks to stabilise stocks and push up stocks for the national team. So, you're curbing any fallout. But I think we will see China underperforming equity-wise. So I think there's a trade, this idea about, I think, being long, various long European stocks relative to China, I think is a good trade.
Okay. And since I'm mostly an FX guy, just kind of my wheelhouse. But I'm thinking from the Aussie point of view, I still don't think that Aussie weakness is over yet. We have seen a really, really sharp rally. Technically speaking, it doesn't look, in my book, it doesn't look bearish per se, but I still have a very difficult time buying it. Yeah. Even with the risk rallies that we still see the Aussie underperform. So that's kind of where my focus is going to be. And actually, if you guys stick around, obviously through the remainder of the show, we're going to talk about a little bit about kind of the Aussie play that I'm looking at, because I still feel that there's so much volatility to come, and it's not like uncharted territory that we've seen before. So make sure you all stick around.
Well,
for
the Aussies. I mean, we got a 4.6% decline on Friday. One day, it's insane. It's an incredible move, and then we saw a 3.5% rally today. I mean, this sort of volatility in a G10 currency is fantastic, but it's also crazy.
It is crazy, especially when, it's not like the Aussie dollars. You remember when the Aussie US dollar was trading almost parity, and then, it's a much different story when it's trading in 50 cents, half that value, and it's still getting those types of moves. Usually when the Aussie dollar is trading down at these levels, you're lucky if you can get a 0.5% move a day. So these 3% moves are outsized, huge. Anyway,
how are we talking? All right, so the stats guys out there, we're talking 6-7 standard deviation sigma moves, aren't we? So I mean, these are very rare.
Nuts. All right, so let's go to the last topic, and let's talk about CPI. Let's talk about inflation. You briefly mentioned it, and if you listen to the Fed governors this week, all the ones that was speaking. Goolsbee is the one that kind of rings in my mind, but there's other Fed speakers that spoke this week, and everybody was talking about inflation expectations. And yes, we may have this pause for most countries, but China, remember, is still very much in the spotlight in the U.S., and we still import a lot of goods from China, and it's one of our bigger trading partners. And everybody's waiting to hear, like Chris says, what's going to be a response from China. I think that we are going to get some sort of response tonight. But anyway, I don't think people are going to feel calm until that situation, the U.S.-China the game of chicken's over. But that's why I believe CPI is really going to matter, because, we as Americans, or anybody for that matter, Americans or any human on this earth, you worry about inflation expectations. You know all these tariff risks are coming. People have bought things ahead of Liberation Day here in the United States. I mean, that's what people do. That's behavior. And so everybody's going to be focused on inflation going into this inflation number, which happens to be tomorrow. And we're going to be focusing on inflation probably just as much as the jobs data. That makes tomorrow's data just as important. And even though we're looking for inflation to fall off a little bit on a year-by-year basis, that's just because we dropped off, 12 months ago, the inflation print, added a print. But core inflation month over month is supposed to tick up from 0.2 to 0.3%. That's the expectation. So what's going to make the market feel a little bit better is if we don't tick up on core CPI. But inflation is going to be in focus. I think the dollar is going to very much move on that data, being how sensitive we are to tariff risks, and the volatility we've seen in commodity currencies and currencies just in general How are you going to look at? I know I just ate up a lot of time. How are you going to look at CPI tomorrow, Chris?
Well, I think you look at the core number on a year-on-year basis because, I think it's expected to tick down. I know you talked about the month-on-month change, but right now, it's impossible to price data because we were waiting for the April series to come out. The PMI numbers don't come out in US until the 23rd, as they do in Europe and the UK. And that captures the new tariff or the tariff rates that came through on Liberation Day. And then we were saying, well, the data right now doesn't reflect any of that new tariff rate. We want to see what happens in the PMI series, the new export numbers and prices paid, that's going to come out then. But now we've got these new numbers that come through. It's just all over the place. So I think, you saw Goldman Sachs coming out, recession call, an hour later they pull it back just after Trump's tariff. I mean, we're seeing banks in Australia at the moment coming out and calling for, NAB came out and have called a 50 basis point cut for the RBA on the 20th of May. I suspect they'll probably be regretting that now because they'll probably be thinking a 25 basis point call is more likely. Deutsche Bank have changed their one. So, you're getting these big banks coming out with big calls like 50 basis point calls and all this kind of stuff. And now they're having to retrace them. So, they can't price things around recessions, and people are changing recession calls, in an hour. That's insane. So the data, we wanted to see the data series coming through, and, we were waiting for the April series, which doesn't come out really. And we've got the University of Michigan numbers on Friday. We'll see what happens there. That's difficult to price in itself because it's down political lines. Republicans are saying everything's great, and the Democrats are saying inflation's going to go to 10%. The New York Empire numbers will be April. But now we're going to get these new numbers through. So, pricing economics is just finger in the air stuff, and again, that's just what makes life very difficult to price. So, I think the CPI matters, but I think market pricing of inflation expectations probably matter just as much as well. So we'll see what happens. But does this hold the propensity to cause risk to move? Yeah, absolutely. So it's a risk event we need to look out for. Absolutely. Anyway, let's go to try. Where are we going? That's a setup. Oh, I'm gonna have a cheeky picture of this, the Nasdaq. Interesting one, because obviously we got the strong downtrend, and we saw the continuation pattern there, and that hit pretty much the target. Not that that situation came through, but the extension of the channel really moved in, and we've seen now markets retrace 50% of the losses that we saw there, and we saw one of the biggest moves in Mag 7 that we've ever seen. And Tesla's up 22%, Nvidia working up 18%. Apple was the one we were probably most looking at out of the Mag 7 plays because they've got so much China exposure. I know Tesla do as well, but Apple are a really interesting beast. They do sell a lot to China, and would the Chinese look to refrain from buying Apple phones as this is kind of don't buy America type thing, buy China, buy Canada, that sort of stuff from a more nationalistic perspective, which I get and I understand, and we talked about it last week. But there has been a big snapback in some of the tech stocks, and I think there's probably a bit of outperformance still that comes through these spaces as we go into earnings season, and we'll have to see what the trends are there as well. But the question now is we've retraced 50% of that move in a little under 2 days. And the question now is can it kick? I'm not so sure, but I mean, I do think that tech can outperform some of the more cyclical areas of the markets. I think banks are going to do quite well, or at least on a relative basis. But we've come back into the 20-day moving average, which has seemingly been a reasonable trend indicator throughout this period. But this now needs to kick, or do people sell into it? So, I mean, we talk about this idea about down the elevator, up the stairs. Well, I think we're seeing, down the elevator, up the elevator in this situation, as I put there in the title. So, a lot to work through, as I keep saying, and we've priced out a worst case scenario. Markets are already trying to build a base, and we've got that pot, and now it's make or break. Can we? I don't think we're going to go back to all time highs again, but I think markets probably chop around in the short term here.
Well, I was very interested, Chris, to hear what you had to say about the NASDAQ. And you noticed how the NASDAQ's at the 50% retracement on his chart. Flip it over, please, Mr. Producer, sir, to Apple, because actually, it's coming out of its ascending wedge. Now, the reason why I say this is upsetting the apple cart is because if you remember about a month and a half or 2 months ago, I had this exact same chart and I'm like, we're in an ascending wedge. We're going to eventually break down. Obviously, the breakdown has occurred. Now that we're bouncing, back into the underside of that wedge. Now, I don't have the fibs drawn out for you. I had to do it myself because it just gets too messy looking in this daily chart. But the underside of that trend line comes in right around the 50% retracement, which is at 214, 215 on Apple. So if the equity markets, as Chris was pointing out, might, especially on a gap up tomorrow morning, we might move up a little higher. Apple should trade into that 210, 215 level. And that's the level that I think is going to be a do or die level for Apple. Now, personally, I think there's a lot more left to the story between China and the US. And I think, as you talked about, you briefly mentioned, the buying America, buying China, buying, not buying, a US product, buying European product. That's really going to play through with Apple. And I think Apple's going to suffer as a result. Its recovery has been less than the NASDAQ 100. So Apple's underperforming. So I think the bounce is going to be a little bit more shallow. So above 200, close to 215, those are levels that I think is going to be do or die for Apple. And I think it's a setup for a decent short. So there you go.
Yeah, cool. I want to bring up the VIX. Now, I don't want to do technicals on the VIX because it's a variance swap effectively. And it's really, for the calculation of the VIX, you're taking a series of different strikes and then weighting it to get a 30-day average. So it's not really based on that supply-demand situation that you would see. A VIX futures is something you'd be better off doing it on. What I've got is the cash VIX there, which obviously got up to 60%. Now, we've gone down to 33%. Now, the way that you want to work this out is if you divide the VIX by 15.9, which is effectively the square root of time, how many days are there in a year? There's 250 days in a year, so you do the square root of that, you've got 15.9. And so if you get the VIX and divide it by that level, it basically what it does is it tells you the expected move up or down on a daily basis in the S&P over the coming 30 days. And so we can see now that the market is anticipating movement or implying movement of 2.1%. Now, this is not realised volatility. Implied volatility is driven by realised volatility. About 70-80% of that movement that's implied is where things are realising. And so we are looking at the VIX now at 33%. And while it has just had the biggest one-day collapse in the cash VIX there that we've ever seen, it's down 18 handles on the day. Obviously, it's coming off a very high base, so that's why you've seen that move. At 33%, I think there's got a lot to do there. So there's still a lot of hedging in the market. If this was to come back to 25%, you're going to see good upside coming through in the S&P. People will reduce those hedges and it will push the cash S&P up further where we are. So right now I'm using this as a guide. The market's implying 2.1% moves every day on average, up or down in the S&P. And again, that just guides your expected movement that you can use really nicely for risk management purposes, stock placement, position sizing, all those factors.
All right, Chris, that really good lesson, especially on the VIX. And you're right, it's coming off, but it's still at very elevated levels, which again, as a trader, this is great for you guys and gals. That means if you haven't opened your Pepperstone trading account, you probably should. So let me take you to the last setup, which is actually the Euro Aussie. And the Euro Aussie in our community, in the Forex analytics community, most traders have been trading around this thing. It's given us so much opportunity over the last couple of weeks. It's a currency pair that you have to trade much smaller, very wide stops. I've literally found myself in 175 pip in profit and in 90 pips of loss. And that happens within a half an hour's time. That's how wild these swings are, but it gives us a lot of great opportunity. In this case, we completed a bull flag pattern. We're pulling back towards the 50% retracement. Previous breakout point comes in around 174.20. That's a level that I'm looking at to get long. Now, that means that would suggest that risk aversion is still going to rear its ugly head, because when this thing bounces, that usually bounces hand in hand with risk aversion. That means as stocks move down, this tends to go up. That has truly been the case. That correlation is pretty on right now. So it is a nice setup. I think it sets up for the 50% retracement, but there's a risk. There's a risk, Chris. We're at the 38% retracement. It might not get down from 177 to 174. It could stay elevated. So that's another risk too. But I'll be waiting for it. But sometimes, you wait for trades and they never come. So
that's right. Patience is key. Anyway, let's go to play of the day. Well, it's difficult at the moment to go play of the day because the biggest play of the day is uncertainty. A headline could come up at any stage. I think the headlines are probably skewed towards the more positive side, but making recommendations without actually being in front of the chart and reacting to flows, price action is just impossible to do. As I say, I think instinctively I like the idea of being long tech relative to cyclical areas. I think there's pairs trades, relative value trades to be traded intraday through ETFs and through sectors. And I suspect that there's probably some interest rate cuts that come out the market in the short term, further down, and maybe some further down, maybe some further upside in 2-year treasuries and some curve flatness to be played through. I think the dollar yen's an interesting one. I've had a look at this one because what we've got is we do have a tight range, and again, a lot of this is going to be driven by what happens in treasury yields as well. But we seem to be carving out this short term range. Of course, we've got the bear flag that's been put in place. That in some ways favours the downside and a push down. And, I think that over a longer term period, I still like the idea that dollar yen comes down to 140. But the price is the price, and it's the only opinion that really matters to me. It's the only fundamental you need in this market. And right now we've seen really good, really strong demand below 146 in dollar yen. It feels like it's building a base, and that's got to be respected as well. So I think if we get a break of 148 to the upside, that to me is the trigger to go long. I wouldn't like to be long, but I think that would be the thing that you're going to see: reduced rate cuts coming out, front end of the curve moving a little bit higher, and those effectively you're going to get a flattener playing through in the curve situation there as well. And so the rate cuts come out. I don't see the Fed cutting anytime soon. I certainly don't see them cutting in May, where there's about a 30-odd% chance they're happening. I certainly don't maybe see them cutting in June either, to be honest. I think August or September probably seems more likely now. So you can make a case for it to go up, but longer term, 140 is still probably the base case. But the price, I say, there's a really good range here. If this breaks the upside through that top end of the range, I think there's a trade then there for me, and that's going to be the trigger there to the downside. I think you get a continuation. So this is a really good setup. I should have had it as this is set up, but it's guiding me, and I think when we get a break of this, then I'm going to be looking to trade it.
All right, Chris. And by the way, last week, great call on the dollar yen. I think it dropped probably 200, 300 pips, literally after you made the call.
You get some
wonderful. Right. Top hat, buddy. All right, so Bitcoin. That's going to be my play of the day. Now, if you guys recall, this is from about 2 or 3 weeks ago. I know that because the way I have my currencies and all my instruments set up on my screen, I know if it was within the last 2 or 3 weeks. We talked about the very similar setup. It was coming up towards channel resistance, and as it was coming towards channel resistance, we were going to look to play it either short side on a break above the channel, long side, a break above. Say above or below. And so that same pivot is coming up. However, something a little bit different today. For all you old school technicians, you'll notice I have 2 moving averages on my screen. The red one is the 200 DMA. Why do I watch it? Well, everybody else watches it, so I got to keep it on my screen because I know everybody else is referencing it. That goes same for the orange one, which is the 50 DMA. Now, when the 50 DMA crosses over the 200 DMA to the downside, which it is, that's what we call a death cross. Now, death crosses are not, I don't worry about them too much, but the psychology of it sometimes does weigh on price. But understanding that it's right up against channel resistance, I would favor the short side while it's below that level, which comes in around, I'd say it's roughly about 86,000, wherever the 200 DMA is. But if we break above it, we can get above the 200 DMA. That's a bullish breakout, despite having the death cross. That 38% retracement, you'll notice, is at 87,817 based on my calculations from the high to the low. I still think there's a long-term distribution pattern happening here. That's why I do think it's a short setup. That's how I want to play it. But you can't rule out a breakout to the upside, because if China and the US make good, European Union make good, next thing you know, Bitcoin's trading at 100,000 again. Can't rule that one out, Chris.
Yeah.
So,
well, I looked at this actually the other day, and since I think 2012, we've seen 11 death crosses on Bitcoin, and if you bought
probably zero,
if you sold, Bitcoin, 10 days later, the market would be up 60% at the time. So, and 50 days later, even 70% of the time. So it's been obviously in a long-term bull market. And I think for me, using these long-term moving averages, it's not a great way to do it when the market traditionally has been so volatile that by the time that they actually come to cross, it's already in the process of building a base. It might be things different now, but because obviously things were just all over the place back in the day when you saw these before, that 50 and 200 days was such a long period of time that really maybe didn't apply. So I think if you're going to use that, you probably want to use something a bit more short term, like an 8 and 21 day, as opposed to 50 and 200.
And to be fair, it's something that I don't even use, but I have to reference it because I know what it is. But what I do like to use moving averages I like to use them as resistance levels in a lot of cases, especially with the 200 DMA. And you have to look back in history. As long as that instrument pivots off the 200 DMA more than it doesn't, that means you have to be looking at it. And that's why I know everybody else is looking at it, so I have to look at it too. But what is happening as well, it's coinciding with that 38% retracement, that channel resistance. We call that a triple confluence. So that's why I think it could actually indeed hold this time around. Yeah, plus, I still think we're in a distribution pattern, Chris. I still do.
Well, I think you've got to, for me, tell me where the Nasdaq's going. I think I'll probably tell you where Bitcoin comes. I know the correlation has broken down a bit, but I think that's still going to be the case in this world.
Well, you think it's going down? Bitcoin's probably going down then.
Well, I don't know. I mean, I don't know. I mean, I think we're at a make or break time. Anyway, there's a lot going on. I hope everyone at home's riding out these markets fairly well. I mean, I'm sure it's a lot of pain coming through in the last few days. Hopefully you've had a bit of a reprieve in this session. Hopefully you've made some money. Anyway, we'll be back next week for more of the trade-off.